All right. Happy Tuesday, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the last week in mortgage today, our weekly whirlwind through all the latest and greatest as it relates to the mortgage industry. Each week, I select some really intelligent people from our lender member network to be my co-hosts each week. So you don't have to listen to me just blather on every Tuesday. This week, really pleased. First time in the co-pilot seat, the Senior Vice President, Chief Operating Officer, QSO Home Lending out of Maine, Lori Michaud. Lori, great to see you.
Great. Thanks for having me.
Absolutely. Thanks for doing it. And also back in the co-pilot seat this week, our good friend from our great partners at MGIC, their Vice President of Sales and their National Credit Union Manager, Chris Perry. Chris, good to see you again.
Hey, Rich, how's it going?
Going good. Chris brings the unique perspective of many years on the mortgage industry side of our business, but also managing MGIC's credit union endeavors nationally. MGIC, a great partner at TMC. We're doing a lot of cool stuff to try to engage with the credit union base in some different ways. And Chris, good to have you back on the show this week.
Thanks a lot. Looking forward to it.
All right. And Lori, before we get started, because QSO Home Lending's business model is kind of unique, I'd love it if you could just start out by telling our viewers and listeners just a little bit about QSO Home Lending and the business model.
Yeah, so we're actually a QSO, which is an organization owned by credit unions. So we're owned by credit unions in the state of Maine. I consider us their mortgage department. So we do their fulfillment services from smaller ones that don't have the resources to originate, to processing, underwriting, closing, selling, and servicing, as well as sub-servicing for their customers. We've been in business. Next year will be 30 years. So
that is so cool. Congrats. And it's all Maine credit unions, right?
It is. We have one in New Hampshire that is an owner based on a merger with a Maine credit union. So we're licensed in Maine and New Hampshire, recently licensed in Mass and Florida. Aren't doing any business there yet. Trying to develop our models, but looking forward to expanding and assisting credit unions.
The QSO model is really cool. I remember like when we first started TMC, and we're kind of like, oh, can QSO? I'm like, hell yeah, QSOs can be members. They're amazing mortgage lenders. Honestly, they lend on behalf of lots of credit unions and perform such a valuable service to credit unions that maybe don't have the expertise or the resources to successfully do it themselves. 30 years in the business, I think, speaks for that, though, Lori. So congrats. That's awesome.
Right.
And Chris, maybe like, are there any other QSOs like QSO Home Lending that I don't know of any? They're like really specific to one state. Do you know of any like that?
So I would say that I have a great appreciation for folks like Lori that run a QSO, because I like to, in more normal mortgage vernacular, I'd say it's a wholesale broker shop. It's a retail model. It's a consumer direct model, mini core and correspondent, and they service loans, all sandwiched into one shop with many service level offerings. So yeah, they're pretty complicated to run. And yeah, there's probably some 20, 25 mortgage oriented QSO or QSO like organizations around the country that aggregate mortgages from, some 4,000 or so smaller credit unions, and some larger ones utilize them for government loans too.
Very cool. That's awesome. And you're right. It is a complex business model. It kind of acts like almost every channel in our mortgage industry, kind of under one roof and one model. I never really thought about it that way, but that's a great point, Chris. I see Lori shaking her head like, yeah,
It's complicated.
Well, very cool. And really excited to get both your perspective on everything going on in the industry. So let's go ahead and get into it. As always, goes without saying, at this point, any comments, questions, thoughts, anything, drop them into the chat or the Q&A, and we will incorporate it into the show. So I've been leading this show, Lori, really all year, most of the year, with interest rate discussions, because like our industry it's like not on pause, but we are so dependent on the interest rate climate on how our industry functions. And interest rates have been the story this year, and all the Federal Reserve's actions, inactions, you could argue from some, that kind of got us to this point. And I guess this point is we're sitting at about 6.5, 30-year fixed as we get close to Thanksgiving here. Beginning of the year, we're in that 2-3% range. All hell broke loose in the spring and shot up to damn near 8%. And things are settling down a little bit right now. Got a good inflation number 2 Thursdays ago that caused the biggest mortgage bond rate rally in like 40 years. Now, it was to go from 7.5% to 6.5%. So you take it in perspective. But curious, Lori, did you see any going from 7.5 to 6.5%? Did you see pickup? Did you see borrowers that were, maybe on the fence that this little drop in rates caused action for them?
Yeah, we didn't really see a lot. The challenge, particularly in our state is, although, inventory's down, median sales prices still continue to rise. I was talking to Chris this week about it, and in our largest county bordering New Hampshire, the median sales price from 21 to 22 was up 16%. So we're still seeing that affordability and inventory is still an issue in our state.
So the Northeast is it's seeing even more than the national trends in terms of listing, you're still seeing affordability issues maybe on par or worse than the national kind of averages in the Northeast?
Yeah, I feel that way, only because we had an influx of people moving to the state with remote work. So we're seeing our housing bought up by out-of-state people, which is a problem for our in-state millennial buyers and first-time home buyers that are looking to buy, haven't been able to find a house. So this year we've seen them able to get in the market. Then with interest rates rising, it pushed them a little out of the market because affordability at 4% versus 7% brings down their buying power. And with higher prices, it limits them.
I want to get Chris's perspective on any national trends he's seen this last month as we've gone through. Sorry, but I got a Amazon at the door. My crazy dogs. I'll try to fight through this, but you did get an influx of people into Maine because of the pandemic, right, Lori?
We did.
And then, Chris, any trends you're seeing nationally on the credit union side just this last month as we start to get towards what is hopefully a more normal market?
I think the inventory issue is still one that is vexing most of the country. Certainly in Maine, you could or areas like that, you could perceive that there was some significant increase in value because of so many folks moving to the area, and maybe there'll be a pause on that. So that might give locals a chance to participate in the local market. But from a national perspective, I don't have a whole lot of clarity on that, apart from I do know that portfolio lenders are in particular approaching the affordability by utilizing their ability to offer intermediate arms. And Lori, as you and I talked about yesterday, we were chatting, that's something that you all are really getting involved in fairly recently, correct?
Yeah, we figured we had to, we have a special product that we offer. It's a portfolio participation product, kind of unique to us. And we decided initially when rates rose, we actually were able to go out there and hit the market with a low fixed rate. But then as liquidity became a concern, we decided to look at some arms. So we're out there offering, 5, 7, 10, 1 arm, using the 1 year CMT and not the 6 month. And then discounting those 1.5% to 2%. And by doing that, our percentage, we historically, we haven't done a lot of arms. I'd say not any. But we're about 27% in arms right now.
And Lori, just talking to a lot of our depository members this year, like portfolio capacity is starting to become an issue just because there's zero secondary market for arms. Like independent mortgage bankers, they just can't write arms. So borrowers that rightfully in this interest rate market want that product, they're going to the local credit union, they're going to the local bank, and it's starting to, I just talked to one like an hour ago. So it's fresh in my head. Like, we can't put another portfolio loan on the books, like, for the next like 2 months. So is that something that you guys are experiencing, or that it has been, those you interact with in your peer group?
So they're starting to talk about it. With this special product, what we do is, again, unique. We participated out amongst 25 or so credit unions. So they're getting a piece of the pie on every loan, not 100% of the loan. And it's also diversifying their portfolio as well as their risk. So yeah, I'm not seeing a lot. I'm hearing a little bit about it, but with volumes down, hopefully we'll be able to sustain that liquidity through this market.
That's so cool. That's something that happens traditionally on commercial loans, participation, big lending, and you got a lot of little lenders that take a little piece. But what a cool way to help, keep room in your portfolio, essentially, while giving those credit unions that you service also some earning assets, even if it's just, a piece of loans. But that's probably to their preference, my guess would be.
Yeah, it is. They're not taking the risk on the entire loan, and they may be not a credit union in Southern Maine, so their Northern Maine credit union needs some mortgages throughout the state. So it's been, we started the program in 2010. Funny enough, traditionally credit unions are refi shops, so we decided we needed to figure out what we were going to do when refis finally crashed. And 12 years later, it's happened finally. But we had the product in place to be able to sustain the purchase volume.
Outstanding. And we had a question come in the chat before we go to Chris. Question for Lori: how did you manage to use CMT versus SOFR, the indice change, on ARMs?
Yeah, so because their portfolio, the credit unions were in agreement that we could use CMT. So they're not traditionally going to be a saleable asset in the market. So we were able to keep CMT.
Awesome. And Chris, sorry, you were just about to talk and I completely cut you off there, but
oh, no worries. No worries. Yeah, actually, I would say that that's fairly common with credit unions and community banks staying with the old index as opposed to moving to the SOFR. And I don't know, I have this perception, maybe it's because I'm used to it as well, but that the consumer is going to prefer a 1-year adjustable as opposed to a 6. But I just wanted to note that, Lori's program is very unique even in the QSO world. I've not come across, I was aware of it 10 years ago, and I've not come across another program like that, and give her lots of credit for spending the time to set that up. And I do think that it's a perfect solution now, where we see credit unions either tapping out on their liquidity because they're lost in deposits, and probably same with community banks. So they're really literally losing deposits. They've lent a lot. They don't have a lot of money to lend, or just they're approaching the current economic status, economy, and saying they're a little bit worried about recession. Maybe we don't want to lend too aggressively. And the program that they've set up really allows them to continue to participate without kind of going all in. And I don't know if she mentioned this, but they've also done a great job at branding that and, kind of selling it to the local community as a purchase-oriented product. So she deserves a lot of credit.
It's awesome. And that is really cool, Lori. I've never heard of anything like that either. And it makes a ton of sense. And good, like this show, we want to use this show to highlight really smart people all across America that are doing things like that, to be creative, to be relevant, and great example of that with this week's co-host. So good stuff. So This is the last week in mortgage today. I'm Rich Swerbinski with the Mortgage Collaborative. This week joined by my crazy barking dogs in the background, as well as QSO Home Lending Senior Vice President and Chief Operating Officer Lori Michaud, and MGIC's VP of Sales and National Credit Union Manager Chris Perry. Some other stuff in the news this week. Days on market growing despite inventory not being super robust. Is Lori, that what you're seeing in your market and Chris nationally?
That's what we're seeing, unfortunately.
Yeah, I think that's actually maybe a little bit of a positive in that it's more normalizing, right? I mean, we've just been in such an unusual marketplace. I'll look for any silver lining at this point.
Honestly, because I mean, it's been a bad year to host a weekly mortgage talk show. So we're constantly looking for the silver linings.
Hey, we're going to be able to celebrate the holidays this year without having to work a ton of hours.
Honestly, I
maybe
remember
I'll get my shopping done early. I don't know.
last year was starting to slow down, but the two holidays before that, it was crazy busy. So that is one nice. There we go. Right, it's the glass is half full. We're not going to be bogged down with the massive pipelines of loans to close out this November and December.
Nor are we going to be doing Thanksgiving on a webinar because of COVID. So yeah,
right.
Another big positive.
No virtual happy hours, and man, it's still surreal. All that we went through these last few years. So, also in the news this week, just some columns about buy down products that are starting to make a comeback. Laura, you guys messing around with any of that stuff at QSO Home Lending, rate buy down products?
We're not doing that at this point. We have it on our radar, but unless we see a demand for it, we're not looking at it. I'm not sure the investors are real keen on it either. So
tough product to sell. Chris, anything you're seeing or hearing on that nationally?
Yeah, lots of conversation about that within our management team. It seems that there's a lot of discussion in the independent mortgage banker world and not a ton of volume on the builder side, though a lot, because builders obviously they got to keep building, they got to keep selling, and they're willing to pony up for the buy down. So a number of loans coming through on the builder side, but not all that many from our independent mortgage banking clients.
It's a great point. You're seeing it a lot on the builder side. It's just the cost to build right now is insane. And, builders, I think you're seeing them dangle that, rate buy down. Hey, instead of 7%, you're 5% year one, 6% year two, some of that. But to Lori's point, not super mainstream, but there were a couple columns about it in the news this week. So figured I'd bring it up. Also, a story that just broke today from the Wall Street Journal. Again, shouldn't surprise anyone, but in the most recent quarter, homes purchased by investors down 30%, for all the obvious reasons. We've talked ad nauseum over the course of the last year and a half about the impact that just corporations buying investment properties has had on the broader issues we're having in our industry. Now looks like we're starting to see some of that reverse a little. Laura, you mentioned, just the influx of people into Maine due to the whole remote work thing. Did you have a lot of investors that came into the state as well and just bought up street blocks?
Yeah, that still continues to happen. It's difficult for, affordability in Maine. You buy a 2-unit and live in one of them and rent the other, and there's none of that even available. So investors are coming in, increasing the rents, causing issues there, as well as second homes. They were coming into Maine and buying second homes, which may have traditionally been a first-time home buyer home. So caused a real problem and continues to.
And Chris, nationally, MGIC guys are doing business all over the place. Anything you guys are seeing, any perspective you have on just the pace of investor purchase of homes and any potential impact of that?
I can't really speak. I don't think we've discussed that nationally, but my own personal perspective is I'm going silver lining again. It's a more of a normalization. Obviously all those cash purchases, really reduced inventory and played havoc with valuations. And although, in the immediate, it may, have a slightly negative, I think if we're able to normalize inventory, that's going to add some stability to the marketplace and be positive for, home buyers, first-time home buyers. They're grappling with, affordability and just being able to find a home that they can buy.
Some comments in the chat just about, people seeing builders utilizing buy downs as part of their marketing strategy right now. Comment from Michaud: is anybody besides builders doing buy? Not really. I think we're seeing some depository lenders that if it's something that they're just putting on the shelves and, but it's if you're a depository lender right now, Lori, you don't really have to, sharpen the pencil immensely. If you can do an ARM in the portfolio at a somewhat reasonable rate, there's no need to add any additional bells and whistles to it right now, is there?
There isn't. And, servicing, they're trying to dust off the rules for that and the servicing side, which, we haven't had to deal with. So I've seen chat in that group on how do we service those now? So
yeah, new to dilemma to deal with, and we'll see what all comes of it. But you think address it's I don't think a main trend we're seeing nationally, but just like any one of these cycles, right? Everybody's dusting everything off, and start to hear about all these products that are viable once every decade or so. But we'll see what happens. This is the last week in Mortgage Today. Rich Swerbinski with the Mortgage Collaborative. About 6-7 minutes left with our co-host this week, Lori Michaud from QSO Home Lending, Chris Perry from MGIC. And just as we look forward, I think everybody in our industries, we're ready to flip the calendar, right? I mean, this has not been the most rosy year. We go into a new year. It seems like we're starting to see the seedlings of what will hopefully be a more healthy mortgage market next year. I was just having a conversation with one of our members a couple hours ago just about the general climate, and conversation was generally along the lines of, man, we could if 30-year fixed rates can even settle into like a 4 to 6% band in 23. Lori, it feels like there is a really strong shadow demand of potential home buyers out there that are on the sidelines for one of a bunch of different reasons, but most notably right now, just affordability, right? It's 6.5%, 30-year fixed. I mean, agree with my sentiments that a 4 to 6% 30-year fixed rate climate could produce a year way beyond what more are expecting next year.
yeah, I think so. I mean, I don't think we saw production really declining until it hit the high 6s into 7s, and that's when we really saw production decline. So I think it'll be steady if rates can remain in that range.
That's a great point, Lori and Chris. I mean, because we saw like when rates were going up, I remember talking about it on this show every week, looking at the MBA application index, just, stripping out the refi stuff and just looking at purchases. Lori's right. As rates were going up from 4 to, 5, 5.5, 6%, purchase apps kept going up week after week through that. And it didn't stagnate and then reverse until we got into the 6s and ultimately the 7s. I don't know what I'm looking for there, Chris. That wasn't even a question. Yeah.
I thought you were handing it to me there. All I could say is, as we project out, we feel like, it's going to be a different marketplace. Of course, working for a private mortgage insurance company, you see a lot more MI when it's more of a purchase marketplace. We have less runoff, than in a refi year, but we're probably looking at the 3rd largest production year, if not maybe the 4th in our company's history in 2023. So we're excited to see more normalization in the marketplace, and excited to hopefully see a nice strong spring market come into play with a little bit more stability in interest rates, hopefully on the other side of the pivot.
I always love getting the perspective, people like you, Chris, that one, have been in the industry for a long time, but that do business all over America. MGIC, obviously, very, very reputable organization and company that is doing business with most of the top lenders all over the country. And I bring that up because last time we talked, you mentioned some things that some kind of leading indicators. Yeah, you talked about like the training that you guys are doing is like at all-time highs right now, and quotes that people are getting. Maybe it's not resulting in the percentage of those quotes is not resulting in MI policies. We got a lot of people out there pricing out MI policies right now, and a lot of indicators that would seem to tell you that even just a little help on the interest rate side, you could see some pretty big pickups in volume pretty quick.
Yeah, I think we fully expect that we are in a kind of a reactionary trough right now. Just as Lori mentioned, that there's such a shock factor in seeing more than a doubling of rates, and a shock factor in those that had been looking at a doubling, almost a doubling in payment. And as we get farther from that huge move, if you're a millennial and you start shopping this spring and rates are in the fives, high fives or low sixes, you're not going to know necessarily what they were or care what they were a year ago. They're going to be the rates that you have in front of you, and you're going to be trying to find a home that you can afford. And so hopefully if that inventory issue, evens out a little bit, that we'll see a strong market.
And Lori, would love to close things out just by getting your perspective on how you're looking at 2023 from the lens of a leader that has been through cycles and has run a really well growing and thriving organization these last few years. Just how you're looking at the landscape as we get into next year, because there's a lot of the difference in the way people view the landscape. To me, there's a lot of diversity in that, as opposed to past years when we're trying to look forward to next year in terms of what might happen.
Yeah, so we've got our business development area really starting to hone in on the credit unions to get them prepared for a spring market and a purchase market. So forget about refis, they're gone. You can do those on the home equity side. But let's look at the purchase market, because we could be a leader out there, and that's kind of what we're focusing on is the business development now, and those relationships to help buyers when the spring market hits, because obviously we're stagnant December, January, February.
What, it gets cold in Maine?
It gets cold and snowy and nobody wants to, but we are now, I'm starting to see a lot more houses come on the market. So people that were hesitant about listing are now, I'm seeing a lot more as I'm driving around, a lot more go on the market. So I think we're hoping to see a pickup in it.
Outstanding. Well, really enjoyed the conversation this week. Lori, you totally having you back on. You just earned yourself repeat co-host status today. So I don't know if that's a good thing or a bad thing, but really appreciate you taking the time out and sharing your perspective on our industry with the audience this week. Thank you.
Thank you.
And Chris, as always, enjoy your perspective. The partnership with MGIC has been a phenomenal one for TMC. I say it all the time. It's really the essence of, what successful partnerships are to us. Good people on both sides, working towards common goals, and very culturally aligned organizations. So nothing but love for MGIC and your vital role in really managing the relationship with TMC. It's greatly appreciated. And thank you for being on the show this week.
Absolutely, Rich. Really enjoyed it. And I second on the partnership. It's been fantastic for us. Looking forward to another great year next year. Looking forward to the 12 days coming up.
12 days of TMC right around the corner. Starts on Tuesday, our signature year-end virtual event. Really fun, really centered around making lenders stronger. You go to mortgagecollaborative.com. You can find out everything you need to know about the 12 days of TMC. Many sessions that will be aimed at lenders sharpening their saw as we get into the start of another year that brings with it some uncertainty. So And to our viewers, listeners, thank you as always for taking 30 minutes out of your week with us. The goal here is to save you time by giving you some perspective on what's going on in the industry outside of your silos. All you podcast listeners, join the live broadcast, mortgagecollaborative.com every Tuesday at 2. A lot of fun this week. Had about 60, 70 people in there, and always a lot of fun as well. So happy Thanksgiving, everyone. We'll see you on the other side of that holiday. And have a great holiday weekend, and we'll see you next Tuesday. Take care, everyone. Thanks again, Lori. Thanks, Chris.
Thank you.
Bye, guys.
Happy
Thanks a lot.
Thanksgiving.
Happy Thanksgiving.